Hi, this is Barry Brooksby. We hear often in the financial world about an average rate of return. Today I want to share with you what that really means. So if you have a portfolio of $1 million, let's make an assumption that that million has a rate of return in 1 year of 100%. So it takes your $1 million portfolio up to $2 million. Looks great. But what happens if in the second year you lose 50%? You're back down to the same million that you started with. However, year 3, you have another great year, 100% return, you're back to 2 million. But unfortunately, in year 4, your portfolio drops again by another 50%. So what's happened? Well, what does this really mean? At the end of a 4-year time frame, you have the same million that you started with. Watch what I do. I'm going to click on the Show Rate of Return button because financial advisors in Wall Street would tell you that you had an average rate of return of 25%. They'd say, look, you're a phenomenal investor. You just averaged a 25% rate of return in your portfolio. Yet you're looking at your balance and saying, wait, I have the exact same $1 million that I started with 4 years earlier. Your actual rate of return is 0. This is the fuzzy math that gets used in the world of financial advising and Wall Street. They use this type of math to convince investors to invest with them. And frankly, it doesn't work. Now, you might think that my example here is being exaggerated. Who has 100% return and loses 50%, back to 100 and loses 50? Well, take a look at this. This is the S&P 500 index, quite possibly the most well-known index in the US. Well, notice, in 1997, there was an aggressive increase of 106%. Then at the peak, in March of 2000, the S&P 500 began to drop dramatically, and over the course of the next 3 years lost 49%. Then, October 2002, it began to climb again through October 2007, 101% return. Then, as we all know, in 2008, the crash began, and the S&P 500 lost 57%, bottoming out in March of 2009. Well, look at the trajectory the S&P 500 is on today. It has climbed and risen to a staggering 184%. The markets are at all-time highs. What does the future hold? The U.S. is over $19 trillion in debt. Social Security nearly has more going out than coming in. The pressure of Medicare and Medicaid. Ultimately, there are only 2 options. Either the U.S. government can stop spending by 50% for all their programs, or they can increase taxes to take care of all these unfunded liabilities. Experts have said that taxes would need to double in order to meet those unfunded liabilities. Well, look at this S&P 500 index. My example of 100% return and a 50% loss is no exaggeration. This is reality. And now the S&P 500 is on this climb, and who knows what the future holds. Will it continue, or will there be another major crash or correction? Consider where your portfolio is sitting today. Are you at risk, or do you have certainty and predictability in your portfolio? The next time you hear a financial advisor or some television commercial promoting financial advice use the word average, it should be an immediate red flag for you. Average is completely meaningless. At the end of the day, what does it mean to you? And that is an actual return. We want to get to the bottom line and discover what's really happening in someone's portfolio regarding a rate of return.